So here we are discussing consumer credit in Chapter 6. And what's interesting about consumer credit is that no matter your age, no matter young, old, somewhere in between, uh, we encounter credit, consumer credit, meaning uh, if we don't have the cash, for example, to purchase something. We can go about obtaining and purchasing or buying that via consumer credit, meaning that we're able to consume. All right. So if we don't have the income available to consume, or we find this is if we don't want to use all of our income, these are all choices that we have to make, where opportunity costs lie throughout this entire process. But what's interesting, again, we'll be moving forward quickly through this, but with consumer credit, is that this is our access, this is our ability to essentially to consume now and pay for that at a later date. Okay, this is kind of the basic idea. Not good, not bad, but that's the reality. So learning objectives, will go through the definitional piece of this first, defining consumer credit, analyzing its advantages and disadvantages. And there are lots of both advantages and disadvantages. This is a fact of life. We don't always purchase things with cash. We don't always, back to the basics in economics. Economics is a study of scarcity, meaning, of course, that our desires, wants are unlimited. But however, our resources are limited, So this is where we have to make choices, and consumer credit is what allows us to make to expand our credit, scope of our credit, our desires, and to obtain some of those things that we would hope for that we would not be able to experience, consume, etc., if without credit available to us. Anyways, so onward, differentiating among the various types of credit, assess your credit capacity, and build your credit rating. This is where we get into the nuts and bolts of how it is that you establish credit, why it's important, okay? And it is very important so that you can enjoy, consume those things that you would prefer to do now rather than 10, 15, 20 years from now. Have families and so on and so forth now rather than waiting 20, 30 years when you would not be able to have a family, if you will. Anyway, all these things kind of come into play. So describing the information creditors look for when you apply for credit. And again, we have to know what it is that we're being measured by, and this is what we're talking about when we're describing that information that creditors, our potential creditors, look for when we're trying to seek credit, see it when we're applying for credit. Identify the steps you can take to avoid and correct credit mistakes. Mistakes happen. This is called experience, right? Experience meaning that you make mistakes and you go back and you try not to make the same mistakes over again. And this is the same process with getting your head wrapped around this whole concept of credit. Describe the laws. This is where we get into the regulations, etc. Describe the laws that protect you if you do have a complaint about consumer credit, if there's some problem with your credit report, for example, how you can go about addressing it. So first off, what is consumer credit? Credit is an arrangement to receive cash, goods, or services now and pay for them later. Okay, pay for them in the future. Again, as we indicated before, if you had your choice, if you have $100 in your hand, would you prefer to consume it, or would you prefer to save it, set it aside? There's a much higher opportunity cost associated with what? Setting it aside, not consuming it. And that's in essence what credit does, is it allows you to consume perhaps more than to be able to consume that $100 without actually spending it today, if you will. And we'll get into that. Consumer credit then is the use of credit for personal needs, except for home mortgages. So they just said that's home mortgages are it's just set aside. It's something that's it's typically the largest portion of your credit portfolio has to do with mortgages. And it's just a set aside so that we can kind of isolate it, and we'll talk more about that as we go forward as well. So that's the idea of credit, in more specifically consumer credit, that it's addressing your personal needs aside from home mortgages. All right, so financing alternatives and trade-offs. So with opportunity costs come trade-offs. Remember, that's how we measure our opportunity cost. The choices, your next best competitive option. That's the opportunity cost, and the trade-off is what it is that we're actually, the metric measuring what it is we're actually surrendering, what we're giving up in order to do something. Okay, so 3 ways consumers can finance purchases. Number 1 is to draw on your savings, to spend that $100 that you have in your pocket. That's the finance. That's spending it with using cash, right? Drawing on your savings, using cash, writing a check, etc. Using present earnings, meaning that you are expecting a certain amount of your paycheck, and you set aside that paycheck in order to pay for your expenses, to pay for those things that you want to consume. And finally is borrowing against expected future income. So it's really drawn upon all 3 of these. Typically we look at it as that last bit, as in borrowing against expected future income, but it's not necessarily that. It could be from your current paycheck, it could be from savings that you've already set aside. This is the idea of this is what we're talking about when we're looking at finance. So trade-offs with each alternatives. Of course, it's the old expression that you cannot have your cake and eat it too, because what happens if you eat your cake, the cake is gone, right? So that's what we're referring to when we're talking about depleted savings, reducing emergency funds. So if you spend what's in your savings account that you had set aside for something else, perhaps, then you no longer have that income, that savings rather, to attend to those, to attend rather to those emergencies, and to offset the expenditures associated with those emergencies. Anyway, spending current income on luxuries will eventually reduce future well-being, meaning again that if you can buy this now, you can consume it now, but you will have to do what? You will have to pay for it at a later date. So you buy a nice new car for, we'll just say $25,000. But the problem, of course, is that you would be paying for that over the course of the next, whatever, 3, 4, 5, 6 years, and that reduces your ability to consume at that later date. Spending future income now reduces funds available again for future expenses. So if you buy that car and you pay for this, these are all things that you have to weigh, because you don't know exactly what the future is going to bring, going to present to you. So you have to kind of keep this in mind, is that yes, you need a car. Yes, you need a car that is going to get you to and from work. But you need a new car. Can you do that with a used car? Or can you fix up your old car to the point where it gets you from point A to point B for another year, another 2 years? All these things are taken under consideration, right? So onward, uses and misuses of credit. Before you use credit for a major purchase, consider these questions, and not just these questions, but there are many, many more questions that will run through your head. But these are important things to keep in mind. Do you have the cash for a down payment? And that's a big one right up front. Yes, you want to buy a new vehicle, but do you have enough to pay 10, 20, 30% for the down payment to offset uh, to reduce the amount of payments going forward, to have you so that you have a greater ownership stake in whatever it is that you're purchasing. Do you want to use, do I want to use my savings for this purchase? Do you want to use that savings again that you have set aside perhaps for emergency purposes, etc.? Does the purchase fit my budget? That's and keeping in mind that it's not just about what your paycheck is today or what your budget is today, but looking forward. Are you anticipating earning enough income to justify that expenditure? Could I use credit? Could I use the credit I need in some better way? Always those choices. Opportunity cost. Should I buy that new car? Should I purchase a used car and set aside a certain amount for a vacation in a year or two from now, or even setting aside a certain amount of money for the purchase of that new car in 2, 3, 4 years from now. Can I postpone this purchase? Always when we're talking about, especially again, major purchases, cars, appliances, maybe a new computer, are we able to postpone this current purchase? Can we put it off until tomorrow? Does it make sense? There's always that thought that goes through your head. Can this money be put to better use, really? Okay, by postponing that purchase, the current purchase. And typically, if you think about it this way, we'll put it in terms of food. Have you ever eaten too much? Have you ever had too big of a meal for dinner, and this happens when you get older? So we'll leave it at, well, I'll kind of leave it. I'll be very, very short with this, but you typically don't regret something that you don't have, obviously, right? So if you didn't have that extra piece of cake, you don't regret it the next day. This is very similar to what we're talking about when we're looking at the postponing the purchase of something. Yes, you may miss out on an opportunity. However, as the expression goes, there's always another one just around the corner. So keep that in mind. Not always, but generally speaking, okay? So what are the dollar and psychological cost of using credit for this purchase? Remember, if you go out and purchase that car, you're going to be stuck paying for that car for a significant period of time. Typically, you pay on a monthly basis, so if it's going to be 12 months, 1 year, 24 months, 2 years, 36 months, 3 years, 48 months, 4 years. These are all things to consider, and whether or not that's going to cause you some you always have buyer's remorse, but if this is something that's going to cause significant pain problems for you, then you really, really have to consider these things. Importance and advantage of credit, part 1 of 2. So consumer credit and importance is a major force in the American economy. Without credit, it becomes increasingly, or it's problematic. It's what I mean by that is that if you're back to what I was saying before, if you're young, say you're 25 years of age, and you're thinking about getting married, or you're thinking about having children with your spouse or with your partner, or what have you, and you realize that you need a new vehicle, a new car, a new if you want to buy a home, if you want to again start a family, all these things. They're very expensive. Families are expensive. And I'm sure that you hear that from your parents, or have heard that in the past from your parents. And it's through credit that we're able to do many of these things that would otherwise not be possible. Straightforward, simple as that. So there are advantages of credit. So immediate access to those goods and services. If not immediate, then it's much more at hand, easily accessible than it would otherwise be the case if you had to wait to actually buy that $150,000 home. Might take you 10, 20 years to get the money together to do that. And that's if you were able to control your spending to the point where you're able to set aside enough to do that. Anyhow, it permits purchases even when the funds are low. And there's always that mismatch. Your desires are always greater than what your needs perhaps or your wants are, but also this helps you to access those things that you would otherwise not be able to enjoy today, right? Or need even today, if you will. A cushion for financial emergencies. So rather than spending that $100, if you can go out and borrow $100, you still have the $100 in your pocket or in the bank, if you will. Advance notice of sales. It's easier to return merchandise, especially again if you have access to the credit. That's really what it means. Is that you're able to. It opens up your options so far as shopping is concerned, right? And when you do buy on credit, it's easier to return merchandise. Typically, that's kind of a passé notion, but there is some validity to that. If you go to a store, it's easier for you to return an item because all they do is debit your credit card. They just credit your credit card, however you want to put it. They put the funds back into your credit card, you return the merchandise. And it's also, of course, it adds convenience to shopping. Safety factors, all the things that kind of go along with it. One monthly payment, again, safer than cash. So if you have a credit card, and I would encourage you to not have too many credit cards, because the more credit cards you have, for example, the more difficult it is to track your expenditures. All right. Anyway, again, safer than cash, needed for pretty much all reservations that you have. Car rentals, shopping by phone or on the internet, of course, is that you can use debit cards, you can access your checking account oftentimes through those debit cards, but credit is, using your credit card is oftentimes essential when you again have hotel reservations, car rentals for sure. Take advantage of float time and grace periods, meaning you might have a month to pay off that credit card, to pay off that balance, the outstanding balance, how much you actually owe. It provides you a little bit of a cushion for that. You may end up getting rebates, extended manufacturer's warranties, emergency medical evacuation for travelers, and other bonuses. And these are all things that are spelled out in your agreement with your credit card. And lastly, it indicates financial stability. In order to improve your credit rating, you need credit cards. Simply, you need to have some record of actually borrowing and paying back, keeping up on payments with credit cards, with your credit, actually accessing credit. So it's kind of a double-edged sword, and probably in a good way, I guess you'd say, in that in order to receive credit, in order to grow your credit, in order to improve your credit, you have to employ credit. You have to actually go out there and have credit and have some standing within the framework of the with credit agencies. Anyway, so it indicates financial stability when you're able to use credit properly. So disadvantage of credit. This is the flip side of that. Temptation to overspend. And that's always the case where you go into a store and you have we'll say a $5,000 limit on your credit card, and you see that nice new TV that's I don't know, whatever they are now, 100-inch TV, and you're thinking, oh my goodness, that's what I really want. Although you had planned to spend couple $100 on a significantly smaller television, you see that and it's only $1,500 and I've got $5,000 credit, and I'm going to go ahead and do this. I want to do that. So what do? You overspend. This happens with credit. Failure to repay a loan may result in loss of income, valuable property, and your good reputation. All of these things point toward the term bankruptcy. And there are different types of bankruptcy, but your inability to repay the loan is what comes up in terms of if you have credit and you spend more, you overspend is really what it comes down to. Misuse of credit can create serious long-term financial problems, damage to family relationships, and a slowing of progress toward financial goals. And this is absolutely the case. It's not only the financial piece of it, it's also it has a tremendous impact on family relationships. It can ruin family relationships, it can ruin friendships, and it can the mistakes that you make with credit today. This is why you have to be very cautious. You will end up paying for a long time to come. Okay, so what the mistakes you make today have long-term implications. Oftentimes, especially, it's very much apparent when we're talking about credit. It's other areas too, but you get the idea that we're talking about this personal finance issue of how to deal with credit. And so this is a disadvantage of credit, is that it can be very dangerous. It does not increase total purchasing power, because what that means is that when you buy something, this is all within that same framework. So whether you're paying for something with cash, or if you're paying something with credit, you're not buying more than you could. You're just employing another portion of your accessibility to those consumer items, if you will. And lastly, credit costs money, because if you think about it, think about both sides. If you want to if you want to borrow money, in essence, is what a credit card is. If you want to borrow money, somebody else has to do what? Has to lend it. So think about it again, make it very personal. If you're on the other side of the equation, if you're lending money to someone else to use for their purchases, what is your expectation? One, to get the money back, the principal, what you loaned, and secondly, to get some sort of compensation for being parted from your money, the time value of money. So there's interest associated with it. And we can talk about the interest rate being too high, so on and so forth, but that's just the general idea. Credit costs money. The reason credit costs money is because you're employing someone else's money to make these purchases. Simple as that. So types of credit. So we're kind of drilling down into in terms of differentiating different types of credit. Closed-end credit is a single loan for a specific purpose and a specified amount that you pay back in a specified period of time in payments of equal amounts. You're buying a new vehicle, a new car, and the payments are set up on a monthly basis over a specific period of time. Installment sales credit, installment cash credit, and single lump sum credit. All these are part and parcel of the same thing. Examples, of course, would be with mortgages. Cars and installment loans for furniture or appliances. When you're dealing directly with if you're dealing directly with the seller, in this case, wherever you're buying the furniture from, for example, or the appliances from, setting up payment plans directly with them. Okay, that's closed-end credit. Open-ended credit, and so looking on the left side, or we're looking at closed-end credit again, mortgage loans, automobile loans, installment loans. Open-end credit would be credit cards, cards issued by department stores, banks, credit cards, Visa, MasterCard, American Express, etc. And the last piece would be the overdraft protection. That's with checking accounts. For example, if you have a checking account and you overspend on your checking account, and rather than the check bouncing or being returned, there's an automatic loan process that kicks in from your financial institution, from your bank or your credit union, basically, where you have to pay interest on that for that overdraft protection. So you can use as needed until reaching line of credit maximum. Again, we're talking about line of credit maximum. This is the open-end credit. You have a credit card issued to you, and it might have a maximum amount that you can borrow a line of credit for $500, $1,000, etc. That's the idea, is that that's how deep the well is, your credit accessibility. That's the line of credit. Next, you pay interest and finance charges if you do not pay the bill in full when due. This is, again, straightforward. This is the wisest choice, of course, would be to pay for something with credit and pay the full balance by the end of that term, whatever that is, at the end of the month, etc. And if you do not pay that, then that's when interest on those purchases start to kick in. It continues, the interest continues until you pay off that in essence, it's a loan, okay? Credit cards issued by department stores, bank cards, overdraft protection, etc. These are just examples, again, of open-ended credit. Credit cards, 7 out of 10 U.S. households carry one or more credit cards. I have 2 or I think maybe 3. I only use 1 or 2 typically, but anyway, about half of all credit card users are convenience users and pay balances in full each month. This is the ideal. It doesn't, just because you have a balance at the end of the month doesn't make you a bad person. But the idea is to this is why we're trying to focus on, the wise financial decisions, meaning, again, that you spend what you can, or you try not to overspend it. And the same goes with credit. You don't want to overextend yourself if possible. What that, again, means is that the objective would be to pay off all of your credit card balances every month. And this is an ongoing struggle for most all people. Others are borrowers carrying a balance over and paying finance charges. Again, so half are paying in full. Others are carrying these balances over and paying finance charges as they go forward. Some use cards for cash advances, paying a transaction fee and interest. So this is where you start getting into things where you get offers from your credit card company where they say, oh, you can receive cash, or not necessarily cash, but they would send you cash to your bank account, to your checking account, say $1,000. It all sounds good, but then you realize that there are strings attached, meaning very high interest rates typically associated with that. Anyway, these are all things to be careful of. Co-branding, linking a credit card with a business trade name offers points or rebates on products, services. For example, like American Express has, they're associated with airlines. I think it's Delta, where if you dollar for dollar, you get a mile, or whatever the relationship is. If you spend $500 on your credit card, you get 500 miles of, toward a free flight, if you will, going forward. And there are numbers of any number of offers that are always floating out there. Okay. Smart cards, debit cards. So we're moving into current day, of course. Smart cards have embedded or computer chip. Combine credit cards, driver's license, healthcare ID with your medical history and insurance information. So it's all kind of an all-in-one type of a scenario. Debit cards are often, again, called bank cards, ATM cards, cash cards, check cards. Electronically subtracts from your account at the moment you make the purchase. No delay in payment, meaning that the debit card is actually accessing funds from your check a checking account. In general, we're speaking. So debit card is actually taking, it's cash. So when we talk about money, the concept of money, and I won't go any further than this, but money itself, if it's so liquid, and I know I've mentioned this before, in its most liquid form, we can use those for transaction purposes to buy and to sell things. That would mean cash or check. And I know people sometimes frown upon checks. Oh, they won't accept checks, etc. But the reality is that checks are the same as cash. Okay, checks and cash. And so what happens with the debit card? It accesses your checking account. Is really what it is. So you're writing a check electronically when you use your debit card. If you go to the store, go to drive-through at a restaurant, and use your debit card, you're actually writing a check to that enterprise, if you will. Stored value or gift cards or prepaid cards. So we've all had these, and I have one in my pocket in my wallet that's for $25, and I just haven't had the opportunity to go out and use it. And every time I look in my wallet, I see my prepaid card for, I forget what it was, a restaurant of some sort. At any rate, so it resembles a debit card. It's used in lieu of paper gift certificates, used for business purposes, payroll, travel expenses, government benefit payments, EBIT cards, so on and so forth. Retailer bankruptcy can make the cards worthless. Meaning that if you have a gift card from a company and the company goes bankrupt, then the card is invalidated. No matter if it's $10, $20, etc. It doesn't not worth anything because the company is bankrupt. These are just little things to keep in mind until, of course, they happen. Then it's a real pain. Anyhow, travel and entertainment cards. These are cards that are not really credit cards. They're monthly balances due in full, and that would be Diners Club, which is kind of the original credit card. Or American Express cards. And that's what that means is that you would be paying these in full. And again, as I indicate here, American Express is now issuing credit cards. So it used to be that Diners Club, American Express, you would pay the balance in full every month. So it wasn't really a traditional open-ended credit card. It was an installment payment of 1 month. That was that, okay? And that's, of course, changed now because American Express is issuing credit cards. Smartphone home equity loans. Smartphones use mobile phones to make purchases called mobile commerce. And this is increasingly the case, that we're using our smartphones as their computers, is really what it comes down to. Old people are pretty much the only people that use smartphones for phones, to call people, to talk. I'm exaggerating a bit, but not by much. Smartphones are now to the point where people are using them for, well, I'll just make a stab in the dark here. Over half of their online activities I'm guessing, would be employing smartphones. All right. So it's not just computers anymore, of course. It's not desktop computers, which are completely passe, it seems at this point. Laptop computers, tablets, iPads. It's much of this has moved away from those to your smartphone. Home equity loans. So this is where we're digging into that mortgage area, into the actual home ownership and the home equity loans. Equity means your ownership. So you're tapping into the equity, into the ownership, what part of that home you actually purchase. So specifically, it's based on the difference between the current market value of your home and the amount owed on your mortgage. You can borrow up to 85% of the appraised value of the home, less the amount still owed. Interest on loan is tax deductible. It is set up like a revolving line of credit. So there's an expression, using your home for a credit card. So, for example, you buy a home for $100,000 and you put down 20%, so you have $80,000 outstanding. So you owe $20,000 worth of home. A year later, we'll just say 5 years later, your home goes from $100,000 up to $200,000, and you paid off another $10,000 in total. So you owe $70,000 on that $200,000 home, the home that's now worth $200,000. So what that means is that you have access, your equity, your ownership of the home is not just the $30,000, but it's the additional $100,000. So you want $130,000 of this $200,000 home. And this is what we're talking about, equity, how much you actually own in the home. And you're able to access that equity, if you will, through these loans that we're describing. Okay, and we'll talk more about that again as we go forward. Anyway, debit credit card fraud, these are things that we always have to watch out for. And this is something that I'm guilty of. I've done this before where I haven't signed my card as it's arrived, as soon as it's arrived. And it's not to say that it'll be accessed or whatnot, but you never know. You could have your wallet stolen, your purse stolen, or you could drop your credit card somewhere. You could, any number of things could happen. So this is just another one of those safety features, if you will, signing the credit card so that the merchant can compare your signature to the credit card. Not just, and increasingly been the case where you're supposed to be looking at a driver's license, some other form of picture ID, and I find that to not be the case as much as it used to be. Anyway, treat cards like money and keep them in a secure place. Shred anything with your account number on it. So if you have your account statements, most of these have moved online as well. But if you have paper copies with your account numbers, be sure to tear them up, shred them, what have you, so that they can't be accessed in your garbage, in your trash. Don't give your credit card number over the phone or online unless you initiate the call, and don't write it on postcards. Meaning, don't the postcards are, again, something passe. We won't get into that. This is something that you wouldn't do that regardless, I wouldn't think anyway. But be careful. In other words, be careful. There are a lot of people out there that are trying to access your credit. It really is what it comes down to. Get card and receipt after every transaction, and check for billing statement errors. And this is something you should be doing on an ongoing basis. Even though we've made things much simpler by moving online, much smoother, much more easily accessible, etc., you do have to follow up on these and make sure that the expenditures that show up in your bill are in fact legitimate. It's happened to me. It's happened to most people I know where they've had an incorrect charge on their billing statement, and you have to follow up on these things. Notify the card issue finally if you don't get your billing statement or if the card is lost or stolen. Always have. And the beauty of this is that, again, with access to online, you can typically find customer service numbers. You don't have to necessarily have the numbers. It used to be the case where you would put write the numbers down. You should still do it, or at least have some paper tracking of your credit card numbers somewhere in a safe, secure place. But absent that, knowing that you can access these online, so you can find the numbers for American Express customer service or Visa customer service by going online and getting their 800 numbers, for example, to call them if you lose your credit card. Anyhow, so making purchases online, something that all of us do now, using a secure browser, make sure that you have antivirus software set up on your computer, all the things that are going to go along with that, whether it's on your phone or not, whether it's on your phone or a laptop or whatnot, or your tablet, iPad. You you're making sure that you're keeping track of how you're accessing your online, not just your credit card, but also the merchandise, the merchants rather. You want to make sure that it's a safe, legitimate transaction that you're setting up. Keeping track of keeping records rather of online transactions, reviewing monthly bank and credit card statements. And again, these are online, so for the most part, so you do have to review these expenditures. And if there is a problem, contact your credit card company immediately, or your bank for that matter. So read policy of the website you visit concerning refunds, site security, privacy. That's all that boilerplate, that very small print. Just the same, you should at least glance through these. Keeping personal information private unless you know who's gathering it and why. All this has to be stipulated by the online merchandiser, if you will. Give payment information only to businesses that you know and trust. And these are things that young people in general are pretty hip to these things, but the idea again is that you really have to be careful, cautious out there. Never give your password to anyone online. These are basic cybersecurity points that you have to pay attention to. Do not download files sent to you by strangers, and that's not just in terms of these transactions. This is again basic cybersecurity actions that you would be taking to protect yourself, protect your accounts, protect your financial well-being, and also for not just for you, but anybody who happens to use the computers, for example, or whatnot. Anyway, measuring your credit capacity. This is where your potential lenders are concerned about whether or not if you have the ability to repay the loan, or how much ability you have to repay a given loan, for example. So assessing your credit capacity and building your credit rating, can you afford the loan? You have to ask yourself if you can meet all the essential expenses and afford the monthly payments. Ask yourself what you plan to give up. Very important, right? Opportunity cost. Are you prepared to make this trade-off? And not just for today, but for the length of the entire loan. Debt payments to income ratio. Debt payments to divide your monthly debt payments by your monthly income. Very straightforward. Do not include your house payments, so you keep that, so you set that aside. Consumer credit payments should not exceed a maximum 20% of your net after-tax income. These are rules of thumb. So again, your monthly debt payments divided by your net monthly income, net after taxes. Calculating debt payments to income ratio, for example, if your income is 2136, your less taxes and so on and so forth, and your monthly installment payment is $426. So you take 426 divided by the 2136, and that gets you to 19.94, which is you're very close to that limit, that spending, that credit limit of 20% of your monthly income, right? I'll try to move a little faster through here. I've been dragging, but these are important issues to cover. So your debt to equity ratio, divide your total liabilities by your net worth. Again, setting aside your home mortgage payments, etc., right? So your total liabilities divided by your net worth should be less than 1, of course. Meaning again that your liabilities are less than your net worth. Co-signing a loan, the creditor will give you a notice. And co-signing, this is where asking parents to help, to sign in the event that you're not able to pay the bill. Your parents or whomever that you're asking to co-sign will pay. These are things to be very, very cautious of on both sides, because it can ruin family relationships, and it can also not just ruin family relationships, but it also you're passing on the responsibility to another person. And this is something that you have to be very, very conscious of, and it's something that oftentimes people ignore, but it can have disastrous consequences. For example, if I were to go and have someone co-sign on a loan for a car for $10,000, and after the first month or two I stop paying the bill, who's on the hook for it? The person who co-signed the loan, not just me, but the person who helped me to obtain the credit in the first place. So you really, really have to be cautious of this. If you do co-sign, consider, can you afford to pay the loan yourself? So if you're co-signing for someone else, you really, really have to follow through and pay close attention to this. You almost have to look at it when you're talking about co-signing for someone else, is that you're the one that has to make that monthly payment. Whether or not that's the case, it's one of these things that you really have to be very cautious of. So your credit rating is when you're trying to build simply put, in order to have a good credit rating, in order for it to be a good risk with with the potential lenders out there, the people that are extending the credit, you have to have some credit, okay? So it's very important to have that credit and to access the credit and to borrow responsibly, etc. So good credit rating is a valuable asset, should be nurtured and protected. And you limit your credit capacity, and you pay close attention, and you also make sure that you review your credit on a regular basis, meaning at least once a year. So you check to see what is in your credit report. As most creditors rely on credit reports, they're looking at the same information as you would find in your credit report to determine whether or not you're a good risk. Building and maintaining credit, there are different credit rating agencies, consumer reporting agencies, Experian, TransUnion, Equifax. They have their issues too, but these are the go-to for people when they're trying to determine whether or not you have a reasonable, decent credit rating. The Consumer Financial Protection Bureau, that's at the federal level. They get zillions of complaints, 36,000 complaints about credit bureaus each year. Who provides data to credit bureaus? To get it from banks, court records, finance companies, merchants, credit card companies, other creditors, wherever you're borrowing from or whomever you're borrowing from, it feeds into this credit rating agencies, into these bureaus. So what is in your credit files? The credit bureau files contain your name, address, social security number, birth, so all of your information is out there within the context of these credit bureaus, right? Your employer position, income, your former address, they're looking at everything. And the reason they're looking at everything is because, think about it, if it was the other way around, if you wanted to extend credit to someone, if you're going to lend money to a stranger, you want to know as much about that stranger as you possibly can. You know, the ability to repay, their past history of repayment, etc. And it keeps track of everything. It keeps track of checks returned for insufficient funds, meaning, of course, that if you were to write a check to someone, whether we're talking about paper or electronic, and you do not have the funds available, it's going to be returned. So you owe someone $100 and you write a check for $100 to that person, and you only have $50 in your checking account, it's going to bounce, is the expression, to go back to you, and you still owe $100, but you have a mark on your credit report saying that you overspent, right? So these are not good things. Fair Credit Reporting Act, these are rules, not rules of thumb, but these are regulations and so on and so forth that are set up at the federal level, state level, typically. And what it boils down to is that it dictates, what the parameters are of credit in terms of how long records are kept, by credit agencies, and frankly, they seem to be kept forever. So keep that in mind. And even though it indicates here requires deletion of obsolete information, this is something that you have to kind of keep track of, because their credit reporting is had to go 10, 15, 20 years. So you just have to really be careful of this. Last thing to look at here is the adverse data can be reported for 7 years, personal bankruptcies for 10 years. So they are constantly looking at these windows to make sure that you are a good bet, okay? If you declare bankruptcy, or if you have a history of bouncing checks, for example, you have to get yourself straight for a significant period of time. 7 years for those adverse reports that are mentioned here, and 10 years personal bankruptcy is kind of on your record out there. So you really have to pay attention to these things. So how can you maintain a credit report? Only properly identified persons. I think every year you're given, I think it's once a year you can get a copy of your credit report for free, if you will. Example to prospective employers in compliance with court orders, so they do have access to, there are other people that obviously have access to your credit reports, potential borrowers or lenders rather, etc. Time limits and adverse data. Most of the important information in your credit file may be reported for only 7 years, may be reported for 10 years if bankruptcy has been declared. Unpaid tax liens, can be reported for 15 years, so it's a long period of time. After 7, 10, or 15 years, a credit reporting agency can't disclose the information in your credit file unless you've been are being investigated for a credit application of $75,000 or more, or for an application to purchase life insurance of $150,000 or more. So again, this information is out there. Depending upon the amount of credit that you're actually trying to access, etc., it can be out there for a very, very, very long time. So if there's incorrect information on your credit file, there are avenues by which you can correct these. Mistakes can often occur, even though credit bureaus are required to follow reasonable procedures. When notified, a bureau must investigate the proposed inaccurate data. If you contest an item on your credit report, the reporting agency must remove the item unless the creditor verifies that the information is accurate. So in other words, you can say, wait, this is wrong. This $5,000 charge never occurred. So the credit rating agency would contact the person who asserted, or the company that claim that you owed $5,000, and get clarification on their end, and it may go away. And if you have proof that it should go away, then chances are it will. This takes time. Keep this in mind. It's not overnight. So if you're trying to build your credit, you have to be, and you want to buy something in a year from now even, you should start looking at your credit now and see how your credit rating is out there, so that you can fix problems that do occur. So this is where we get into that piece of it. What if you're denied credit? You receive notification the credit's been denied, and the reasons for the denial, very important. So you check your credit file at the credit bureau. You should have done this up front, but we don't. This is just the reality. If you believe the reasons are on the far left, if you believe the reasons for the denial are valid, then ask creditor if you can provide additional information or arrange alternative credit terms. So the point we're getting at is that this is all negotiable. And even though it's negotiable, even though you can be denied credit, there are things other avenues that you can follow. Typically with creditors, they'll it usually translates into what? Into higher interest rates. But anyway, you can always again apply it to another creditor whose standards might be a bit different. And always, 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 this last piece that we're looking at on the bottom down here on the right, take steps to improve your credit worthiness, increase your income, reduce spending, pay bills on time, and reapply. Of course, the critical part here is that it does take time. Takes time. All right. So if you're not sure the reasons for denial are valid or invalid, ask the creditor to clarify the reasons for that denial. Moving to the right on this tree. So you believe that the reasons are invalid, the creditor has discriminated against you in some manner by denying you access to the credit. Notify the federal enforcement agency whose name you were given. This is all part, they present this to you if they deny your credit. And there are other, going the attorney route, etc., so on and so forth. Typically, though, I'll just say this, that if you are denied credit and it is invalid, meaning that there's something wrong there's something on your report that ought not be there, that can usually be rectified, can be corrected. But the key here is that it's not corrected overnight, unfortunately. So applying for credit itself, the Equal Credit Opportunity Act, or ECOA, it starts with all credit applicants the same footing. It states that you can't be discriminated against, and so on and so forth, right? What creditors look for, the 5 C's, and these are, anyway, they're looking for the 5 C's: character, capacity, capital, collateral, conditions. Character, do you pay your bills on time? Capacity, can you repay the loan? Do you have the capacity, the ability to repay the loan at all in the first place? The capital, what are your assets and net worth? Do you have some collateral? What property do you have that you can put against that loan? Do you have some ownership in the home, so on and so forth? Do you have physical assets that it can be used collateral? That's what collateral means. Condition, what economic conditions could affect your ability to repay the loan? Is your job on safe ground? Or do you have a job that's you could potentially lose in relatively short order? All these things kind of go into it. Again, the 5 C's of credit: character, capacity, capital, collateral, and conditions. FICO. So the FICO is your credit score, is the information in your credit report used to calculate your FICO credit score. This is the actual measurement. So it goes between 300 and 850. The higher the score, the less risky you are. So if you have a credit above 800, that's a very, very good credit. Advantage score was launched in 2006. Does not count debt collections that have been paid off. So it's a different way of measuring. So FICO is one, and Vantage score is another. And this is when we start getting into the ability to repay. The Vantage score goes in. The FICO is set up by very, very straightforward parameters. Vantage score, it kind of looks at things, and it maybe more realistically, maybe not. But the point is that the difference is that the Vantage score has much more computer modeling that's associated with it than your FICO score. FICO score is very, very straightforward. What is in your FICO score? The breakout length of credit history, and these are, again, just trying to determine what your overall income is and the ability to pay, so on and so forth. And it looks at the importance of different aspects of your outstanding credit, really is what it comes down to. So new credit, 10%, length of credit history, 15%, payment history, 35%. So the two biggest chunks are the amount you owe and your payment history. They account for 65% of that total pie that they are using to calculate your ability to repay. The amounts you have outstanding and your payment history itself, those are the most important. Again, now what if your application is denied? Ask questions. ECOA, gives you the right to know the specific reasons for the denial. And again, these are pointed out. So if you're denied credit, they provide you with the access to um, the phone numbers and so on and so forth, who you can contact, etc. If the denial is based on a credit report, you are entitled to know the specific information. After you receive the information from the creditor, you should contact um, to find out exactly what's going on. You may ask the Bureau itself to investigate any inaccurate or incomplete information and correct its records. And this happens. It happens quite frequently. So kind of bear that in mind. How to improve your credit score. You can go through other people that are very helpful. It's a way, but it does cost money. But you can do a lot of these things on your own. So you start with getting a copy of your credit report. Review that for accuracy. Ongoing, paying your bills on time. Understand how your credit score is determined. Learn the legal steps involved to improve your credit report, and beware of credit repair scams. And these are numerous out there. So you have bad credit, and the reflex action is, how the heck do I fix this? And that's where there are these credit repair scam operations that are always going out there. So you have to be very, very much aware of those. Avoiding incorrect and credit mistakes, the Fair Credit Billing Act, and these are various acts, reforms, government regulations, government-driven aspects to this credit that go back, again, this is 1975, but there have been very, very recent ones as well, and CPB, the Consumer Protection Bureau, and Consumer Financial Protection Bureau, rather. And at any rate, so this Fair Credit Billing Act sets procedures for promptly correcting billing mistakes, refusing to make credit card or revolving payments on defective goods, and promptly crediting your payments. So there's an avenue by which you can correct these mistakes. In case of a billing error, rather, contact your creditor first. And these are things that where credit, why when you buy something at credit, they're the ones that act on your behest. Oftentimes, you should still contact, the actual merchant as well, but you can typically go through your credit card company. They're usually typically very, very helpful. Credit card company has 2 billing periods, but no longer than 90 days to correct the account or to tell you why they think the bill is correct. So that's their aspect of it. So they have to do the research on their end, but after 90 days, if they can't correct it, the billing can go through. So this is why you should be contacting the merchant as well. Your credit rating is not affected while item is in dispute. So again, keeping these things in mind, it's out there. You do have time, but the clock ticks, tick tock, tick tock. Your credit during the dispute, a creditor may not threaten your credit rating, and so you have this time frame in which you can deal with these disputes is really the takeaway. So finally, after explaining the bill, the creditor may report you as delinquent on the amount of dispute and take action to collect if you cannot pay in the time allowed. So you can dispute it, but if the dispute is not settled and the credit card company indicates that you are on the hook for this, then you do have to pay this. Just the same, lastly, you can still disagree. You can still go back and disagree. If there are defective goods or services, you may withhold payment on any damaged or shoddy goods or poor service if you have paid for them with a credit card, as long as you have made a sincere attempt to resolve the problem with the merchant. So twofold. One, contacting the merchant. Secondly, going through the credit card company. All right, so you have to keep these things in mind. You do have to reach out, contact the merchant. Identity crisis. Here we go. So what do you do if your identity is stolen? This happens with increasing frequency. Contact the fraud department in each of the 3 major credit bureaus. And again, tell them to flag your account with a fraud alert. And there are numerous companies out there now that are on top of these things with if your identity is stolen. And it may actually be worthwhile to contact, I think it's LifeLock is one that I've heard of, but where they do a lot of these steps for you. But just the same, you have to make sure that you do contact these credit bureaus. Is very, very important. So contact creditors of any accounts that have been tampered with or opened fraudulently. In other words, contact your credit card company immediately. Filing police reports, and these you'll be directed to do this by your credit card company, for example. But you should always keep this in mind: is that you should file police reports and keep copies again of all of these things, meaning paper copies if you have, or electronic PDF files, what have you, so that you can keep track of the of these records yourself. So tear and shred personal information before placing in trash. And again, we move more and more toward electronic, but still there are typically hard copies of things that we have that we should certainly shred. Anything that has our name on it, any kind of account numbers, etc. And further, cancel checks, close bank accounts if there's a problem, to stop this, you have to put a stop to this immediately. And so you've got to contact all these different avenues, because typically what happens with identity fraud is that they have access, or they gain access to virtually everything. So you really have to go through the whole process here in order to remedy this. And it takes time, but the clock is ticking, so you have to act very, very quickly. Complaining about consumer credit. Describe the laws that protect your if you have a complaint about consumer credit. Now first, if you have a complaint about credit, try to solve directly with the creditor. Go to the merchant that we're talking about. If that doesn't work, there are formal complaint procedures, and there are a variety of major consumer credit laws, as I had mentioned before. You may take legal action as a creditor, but you should also be aware of the following important credit consumer laws: Truth in Lending, Equal Credit Opportunity Act, that's the ECOA that I mentioned before, Fair Credit Billing, Fair Credit Reporting, Consumer Credit Reporting. So there are tons and tons of these out there, laws that are associated with this. Your rights under the consumer credit laws. Lastly here, if you believe you've been refused credit due to discrimination, you can complain to the creditor and let the creditor know you're aware of the law. Very important. Confront the creditor on this. Secondly, file a complaint with the government entity that's associated with this. If all else fails, you can sue the creditor in a federal district court. Hopefully it won't ever get to that point, but these are all things that are available out there for you.